What's going on, dividend chasers? It's the Dividend Bloodhound here with another investing video. Today we are going to talk about the drip and what the drip actually is towards your portfolio. As always, before we get started, I'm just going to plug the channel a little bit. If you're new here and you like the content and my content brings value to you, please hit the subscribe button below. If you're a returning visitor, thank you very much for coming back to my channel. Please smash that like button because it will give me a huge boost in the YouTube algorithm. Right then, let's get down and to it. So the DRIP is an acronym for Dividend Reinvesting Plan. So all the dividends that you get from your company that you are invested in, you reinvest in that company. Now that might not always be possible if you own shares in a big company, or to actually get a stock to drip, you need to own a considerable amount of shares in the company itself. Like for example, if you own a share of Boeing, or 2 shares of Boeing, shall we say, your quarterly return, just as a brief example, because I own Boeing, I got, for 2 shares, I got £2.66 per quarter, and then times that through obviously for the year. And that's not going to be enough with 2 shares to obviously drip into buying another share. But you can apply that in another way by using that money to buy other shares. So dividends, so your dividends are paying to your account all the time. So like if you've got quite a well diversified portfolio, dividends will turn up at your account on a regular basis. And as I previously said, you won't be able to potentially afford a share in the company that you've received the dividends from. But what you might be able to do is afford a share in a slightly less valuable company, but keep that money essentially within your portfolio anyway, which is what we're getting at. And then your portfolio will grow bit by bit. Each time you receive a dividend, you buy another share in another company, and then by doing that, you increase your shares in that company, and then when that company pays dividends, you get a little bit more. Now, a brief example of this in my portfolio, I would say, is take that share, that dividend payment that I got from Boeing, £2.66, and then add to it a dividend from IBM in the same week, another £2.60. Now with that money, I can't afford to buy either one of them, but what I can do is buy a share of BP stock. Now BP is massively reduced at the moment anyway, due to, we all know by now, so I'm not even going to bother saying it, but and the actual oil crisis issue that's going on right now. So their shares are quite cheap, so you could buy that and then just stack them over and over and over again, and then your dividend payout from them will be bigger. And this is quite a good way of doing things, and it's really another version of compounding, which we know what compounding is, and it's the time that you spend building your portfolio. The way I view it is, take having a tree, or I don't know, you could even use a bonsai tree or something like that. You got a little sapling right at the start, and then each time you get a dividend payment coming in, that's you watering the tree a little bit, and then it grows a little bit, and then you water it again, and it grows a little bit more. That's the way I like to think about it. And the other way of doing it is it's similar to dollar cost averaging. So it means that you buy or you spend your dividends at the time that you get the dividend. So you buy a share in the company at the price, no matter what the price is at the time, whether it's massively reduced at the moment or whether it's at near its peaks. And then over time, you get sort of like a lower cost overall. Now, obviously, the better time to buy is when something is massively reduced. But we all know how the market usually works. The bulls are around for a lot longer than the bears are. So this sort of opportunity that we have here and now, literally here and now, we won't actually have forever, and then soon the market will eventually pick back up again, and it'll start getting more and more expensive to buy your stocks. But you're not going to not invest your dividends in that, are you? You're still going to want to use your dividends. You just have to pay whatever the market cost is. Now, sometimes if you go direct to companies, if you are like a considerable shareholder in the company, or you own enough shares in the company to actually drip and buy a new share each time, you can actually go direct to the company to reinvest your dividends. A lot of companies like this because that's kept from their private stock, so it's not done on the stock exchanges at all. It's done between you and said company, and they might actually offer you them at a much discounted rate because it's from their private stock and they actually like your loyalty, so to speak. So you might find you get yourself getting a better deal that way. But what I would stress about that is that you need to be like, it's got to be worth the company's time at the end of the day. And as we are investing in multi-billion-pound companies, you need to own a considerable amount of shares or wield some power in the shareholder world. I'm just going to turn my page here. I'm using a couple of notes for this one. So my little example here is, so let's say we want to drip into Shell. Now, Shell is considerably discounted at the moment, as we all know, hovering around the 11, 12, 13 pounds a share-ish. Now, at present, to drip one share into that company, you need to own roughly 180 shares of Shell to per quarter be able to buy another share. Now, working out that value, that turns out to be well over £2,000 worth of the company that you need to own to do that. So obviously for some people, especially smaller investors, that's not obviously going to be an option. I mean, I only own a couple of £100 myself, but my portfolio isn't huge either. It's only sitting at about the £4,000 mark. You don't want to make your portfolio too heavy towards one company. You need to keep that diversification in there if you want to have a balanced portfolio. If you're not sure what diversification is, please check that out in a previous video, and then you can come back to this one here. I will post a link in the description below. You could, in theory, Trading 212 do offer a way to drip into larger companies, because they do fractional schemes, and something like so a bigger stock like but I'm just going to go straight back to Boeing or Lockheed Martin, or companies that are considered like their share prices are big. Although Boeing is heavily reduced right now, it's still about $170 to buy the share. But companies like Trading 212 and in the future Free Trade, they offer fractional shares. So that £2.66 that I did get, if I was inclined to with Trading 212, I could buy a very small segment of a share with that money, and that is a direct way to actually do the dripping, so to speak. So you can do it that way as well. It's completely up to you. I mean, Free Trade doesn't have that option at the moment, or at least not for all its users, because I'm one of them and I can't do that at the moment. But I know Trading 212 definitely does, so you could definitely take advantage of that. Literally, yeah, drip is part of, or dripping is part of the magic of compounding. As already mentioned, it is a key tool in your toolbox of investing, with a bit of patience, to really get that compound growth into your portfolio. And it's literally like layering block by block by block and nurturing your portfolio over time. So, and you can do this at the lowest level and at the lower level or the lesser funding level, all the way up to people with thousands of pounds, tens of thousands, millions or whatever. Everybody will still use this same sort of building block approach. You're just keeping, can't stress the importance of not spending your dividends. Keep it and buy more shares with your dividends. If you do this, you unlock the potential of compounding, which I believe is known to be one of the wonders of the world. I recently posted on my Instagram a little diagram of basically what $1, yep, that's it, just $1 would be worth had you left it invested in the market. I'm going back some time. I think it was invested in 1880 or something like that. But $1 invested in 1880's value today would be $177 on its own. But then from that, you would have earned over $1,200 in dividend payments over that time, and that's just that's just one. That is just $1. Which, you know, how impressive is that? That really is the power of compounding. Imagine doing that with hundreds, thousands of pounds, and that is exactly what these very successful investors do. The likes of Warren Buffett have been doing that for decades, and the guy's done that because he's an absolute master, and he still lives. He's one of the richest men in the world, and he still drives the same 30-year-old car, and still lives in the same house that he bought 30 years ago as well, purely so he can get as maximum, not that he needs to, but purely get absolute maximum money into being able to grow his investment. Now, a lot of billionaires in the world, like Jeff Bezos, Bill Gates, if they walked along and they saw a $10 note on the floor, it wouldn't really be worth, or they'd have the attitude that it wouldn't really be worth their time to bend over and pick that up, because in the time that they've gone and picked it up, they would have made thousands of pounds, or their companies would have made thousands of pounds. Warren Buffett would have a different outlook on that. He would pick that up off the floor, hold it up and go, that's the start of my next £1 billion with the power of compounding. That literally would, in his company, Berkshire Hathaway, $10 put in would probably go far, or would gain so much value over 10 or 20 years in the compound, with respect to the compounding and the drip that we've spoken about today. So yeah, that's all I wanted to talk about today. It's a nice subject, and I'm really trying to get content out there that would be helpful to newer investors. If you like this, please give the like button a smash. Please check out my other videos if you're new to investing, and give the channel a subscribe if you could, please. That would be absolutely great. And I will see you in the next video. See you soon. Bye.